Within the world of trading there are a variety of myths that do not hold up to intellectual scrutiny. These myths have been part of investing folklore for generations, and they roll off the tongue of those on the supply side of financial markets very easily. Upon first hearing, they sound logical and intuitive and appear to be neat summaries of decades of investing wisdom. Unfortunately, this is not the case, and these myths are anything but logical. Let's look at the myth of time in the market versus timing the market. The concept of time in the market is based around very simple tenets. First, markets and their component equities suffer from extreme short-term volatility, which is washed out of the market over the longer term. This volatility may lead to short-term downturns. Second, markets are random and unpredictable. This is commonly distilled as the random walk hypothesis and is a cornerstone of the efficient market hypothesis, EMH. A consequence of these two elements is that no one can predict the future, but it is always a good time to invest. Third, missing the best days will cost you dearly. Finally, the market always recovers and, by extension, good stocks always recover. Thus, the central tenet of this myth is that the market cannot be timed. Therefore, the only logical thing to do is to remain in the market through all periods, no matter how turbulent or volatile they may be. Let's also look at two additional issues, which are adjuncts to our primary myth: dollar cost averaging and survivor bias. All three are interwoven in such a way as to provide a compelling case for their blind acceptance, but, as we will see, when exposed to scrutiny, all are shown to be little more than fairy stories that have existed without foundation for generations. Within most financial texts you will find reference to dollar cost averaging. References to dollar cost averaging go back to about 1925, when Robert Montgomery in his Financial Handbook urged investors to undertake a diversification of maturity strategy, because the constant reinvestment of funds places one in a position always to take advantage of such price opportunities as arise. This notion took hold in the financial community with little or no challenge. Some rigor was applied to the concept in 1967 when Cohen, Zinberg and Zierkel said, dollar cost averaging allows one to buy a greater number of shares of any stock when the price is down. Dollar cost averaging is most helpful in buying growth stocks. This strategy is based once again upon the notion that markets or instruments cannot be timed, and therefore the individual is best to be in the market all the time and to employ a strategy of regularly investing set amounts of cash. The argument is that in doing this you smooth out the fluctuations in price and end up effectively loading up on an investment when its price is low. This has the impact of lowering your overall entry price. It seems intuitively correct that dollar cost averaging provided a lower average entry price, a hedge against volatility and therefore a more stable return to the investor. However, intuition is a poor yardstick by which to judge matters of money. After all, it seems intuitively correct that it is not a loss until you sell, or that you can never go broke taking a profit. Unfortunately, intuition is wrong on both of these counts, and it is wrong regarding dollar cost averaging. Brokerage firms promote dollar cost averaging primarily with two rationales. First, they argue that returns are augmented because more shares are purchased when prices are low and fewer when prices are high. Second, they assert that dollar cost averaging enhances investor utility by preventing an ill-timed lump sum investment. However, empirical evidence does not support either of these contentions. Optimal rebalancing and buy and hold strategies convincingly outperform dollar cost averaging on theoretical grounds as well as on the basis of numerical simulations. Historical evidence also supports these two strategies, though the empirical differences are not significant. This raises the question that if dollar cost averaging is a discredited idea, why do people hang on to it? Part of the answer undoubtedly lies in that the people involved in financial markets and the provision of financial advice are largely remarkably ill-informed about the nature of the business world they operate in. It is easier to give answers that seem intuitively correct rather than to critically evaluate matters and to go against the tide of opinion. To paraphrase Socrates, just because everyone thinks it is a good idea does not mean that it is. Let's look at survivor bias now. Whenever you visit the offices of a stockbroking or financial advisor's firm, you will generally see a long-term chart of the All Ordinaries Index. Such a chart is generally used to illustrate the point that the market always recovers any lost ground. The implication is that if you buy a share, all you have to do is wait because the market always recovers to a new high. However, such a philosophy is built upon a degree of intellectual dishonesty. The index you are viewing may make a new high, but this does not mean that the stocks you are buying will participate in this recovery. The implication that all shares recover to a new high is a false one, and the use of an upwardly biased index to highlight this point is somewhat lazy. The reason for this is that indices have an upward bias due to the interaction of two correlated factors. Firstly, there is a great deal of churn within an index. Shares that can maintain their places in the index are retained, whereas those that cannot are dumped. The implication is that shares that are profitable remain in the index while those that are not are removed. This churning feature is a function of a phenomenon known as survivor bias, and it is well known to anyone who understands testing of natural systems. Within any given system there will also be what are known as survivors. These survivors can and do exert an upward bias in any results that the system generates. Therefore, they have to be compensated for in any interpretation of the results such a system generates. Without doubt, the blame for perpetuating these myths lies squarely at the feet of the advisory community. These platitudes roll easily off the tongue and they sound logical.